Employee participation in private funds, whether through carried interest, co-investment, or equity ownership, has become a strategic lever for alignment, retention, and long-term value creation. But beneath the surface, these structures carry real economic weight and operational complexity. As firms scale or institutionalize, the design and administration of participation programs become central to governance, investor relations, and fund performance. This article breaks down the mechanics, motivations, and implications of employee participation with a focus on fund administration and economic impact. What does employee participation actually look like? Participation structures vary widely, but most fall into three categories. Carried interest vehicles. Employees receive a share of the fund's profits above a hurdle rate, typically through a separate carry vehicle. These are often tiered by seniority and subject to vesting schedules. Co-investment programs. Employees invest alongside LPs in specific deals, either directly or through feeder SPVs. These programs may be discretionary or structured and often require financing support. Equity ownership in the GP or management company. Employees may hold direct or indirect equity, including profit interests or phantom equity. These structures are common in spinouts and succession planning. Each structure introduces distinct legal, tax, and operational considerations. Carry vehicles require precise capital accounting and waterfall modeling. Co-investment programs must balance access, liquidity, and compliance. Equity ownership demands valuation, governance, and buy-sell mechanics. Why firms offer it and what it costs. The strategic rationale is clear. Participation aligns incentives, retains talent, and fosters ownership mentality. But the economics are far from trivial. Dilution and economics. LPs may scrutinize carry splits or co-investment allocations, especially in first-time funds or emerging managers. Firms must justify how participation enhances long-term value. Financing and liquidity. Employees often need financing to participate, which introduces risk. Some firms offer internal loan programs or third-party solutions, but these require oversight and disclosure. Valuation and tax complexity. Equity grants and profit interests trigger valuation requirements for tax and accounting purposes. Phantom equity may defer tax but complicate payout mechanics. Administrative burden. Tracking ownership, vesting, capital flows, and tax reporting across multiple entities and individuals adds cost and complexity. These programs often require bespoke systems and dedicated oversight. Firms must weigh the strategic upside against the operational and economic cost. Operational considerations for fund admin teams. From a fund administration standpoint, employee participation introduces multi-layered complexity. Entity structuring, carry vehicles, co-investment SPVs, and equity plans often require separate legal entities with distinct governance and reporting. Capital accounting. Administrators must track contributions, distributions, vesting schedules, and performance allocations across individuals and entities. Tax reporting. Depending on structure and jurisdiction, firms may need to issue K-1s, W-2s, 1099s, or other tax documents. Timing and accuracy are critical. Compliance and controls. Participation programs must comply with internal policies, investor agreements, and regulatory frameworks. This includes eligibility rules, disclosure requirements, and conflict checks. As participation expands beyond senior leadership to broader employee bases, scalability becomes essential. Fund administrators must build systems that can handle complexity without sacrificing accuracy or transparency. Final thoughts. Employee participation in private funds is often a core part of the economic model. Whether through carry, co-investment, or equity, these structures shape how firms attract talent, share upside, and manage long-term alignment. For fund professionals, lawyers, and service providers, the takeaway is clear. Participation programs must be treated as financial instruments, not just HR tools. They require thoughtful design, rigorous administration, and clear communication with stakeholders.